Imagine if there was a way to look at any market at any point in history and know exactly when a massive trend was about to start, before the rest of the world even realized it. What if you could ignore all the daily noise, all the chaotic news headlines, and focus on just a few critical price levels that act like tectonic plates shifting beneath the surface of the financial world? For over a century, some of the most successful traders in history have whispered about a secret method. A method not based on complex math or high-frequency computer algorithms, but on pure human psychology and the natural laws of supply and demand. Today, we are going to take this legendary approach, put it under the microscope of modern data, and see if it can actually make you wealthy in today's unpredictable markets, or if it is just an outdated relic of the past. Before we reveal the exact rules of this system, let's address the elephant in the room. Most trading advice you see online is complete noise. People draw hundreds of lines on their screens, hoping that some magical combination of indicators will predict the future. But the truth is, the market only moves because of one thing: the collective decisions of millions of buyers and sellers. When those decisions reach a boiling point, the market breaks. If you can identify those exact boiling points, you have an edge. The system we are looking at today was designed specifically to find these boiling points. It doesn't try to buy at the absolute bottom or sell at the absolute top. Instead, it waits patiently for the market to prove itself, and then hitches a ride on the back of the giant trend. Let's find out how it works. The system we are analyzing today is none other than Jesse Livermore's pivotal point system, created by the legendary speculator Classical Technical Analysis. Livermore is widely considered one of the greatest traders who ever lived, famously making a fortune of $100 million during the Great Depression crash of 1929. At the core of his trading philosophy was a concept he called the pivotal point. Livermore believed that stocks do not move randomly. Instead, they move in a series of psychological waves. When a stock price reaches a new high or a new low, it encounters a psychological barrier. If the price can break through this barrier, it indicates a massive shift in supply and demand, signaling the start of a major new trend. The pivotal point system is a systematic way to identify these barriers and trade the breakouts that follow. To understand why this system is so famous, we have to look back at how classical technical analysis used it. During the early 20th century, there were no computers, no moving averages, and no digital charts. Livermore kept track of prices by hand, writing them down in a leather ledger. He noticed that whenever a stock price hit a previous major peak and fell back, that peak became a pivotal point. If the price later returned to that exact level and managed to push through it, it meant all the sellers at that level had been exhausted, and the path of least resistance was now straight up. He used this exact logic to short the market in 1929, waiting for key support levels to break before putting on his massive short positions. It wasn't about guessing. It was about waiting for the market to confirm his thesis. So, how do we translate this 100-year-old methodology into a precise, rule-based quantitative strategy that we can backtest today? First, we must mathematically define a pivotal point. In our modern implementation, we look at the historical price action of our target asset, SPY. We identify key resistance levels, which we call pivotal tops, and key support levels, known as pivotal bottoms. A pivotal top is established when the price reaches a local peak and then retraces by a certain percentage, confirming that sellers have stepped in. Conversely, a pivotal bottom is formed when the price hits a local low and bounces back. These points remain active on our chart as invisible lines in the sand, waiting for the price to return and challenge them. The trading rules themselves are elegant in their simplicity. We enter a long position when the price of SPY breaks above the most recent pivotal top on high volume, signaling that the bulls have taken complete control and a new upward trend has begun. To protect our capital, we don't just hope the trade goes our way. We implement a rigorous risk management system. Once we are in the trade, we use an average true range, or ATR-based trailing stop-loss. As the price moves in our favor, this stop-loss line is dynamically raised, locking in profits while giving the trade enough room to breathe through normal market volatility. We only exit the trade when the price falls back and crosses this trailing stop line, or if a new pivotal bottom is broken to the downside. Now, let's put this legendary strategy to the ultimate test. Many trading gurus claim that classic trend-following systems no longer work in today's highly efficient, algorithm-dominated markets. To find out the truth, we programmed the exact rules of Jesse Livermore's pivotal point system and ran a comprehensive backtest. We chose the SPDR S&P 500 ETF, ticker SPY, as our testing ground to see how the strategy performs on the broader market. The backtest spans a massive 10-year period, from August 8, 2016, all the way to August 8, 2026. This decade includes a wide variety of market conditions. The prolonged bull market of the late 2010s, the violent COVID-19 crash of 2020, the high inflation bear market of 2022, and the subsequent recovery and tech-driven rallies. Let's see if Livermore's wisdom held up. The results are in, and they are fascinating. Over this 10-year testing period, the strategy executed a total of 28 trades. The win rate came in at 57.1%, which might surprise some of you who expect a successful system to win most of the time. However, in trend following, a high win rate is not necessary. What matters is the size of the winners versus the size of the losers. Let's look at the bottom line performance. Jesse Livermore's pivotal point system generated a total return of plus 31.5%, which translates to an annualized return, or CAGR, of plus 2.8%. In comparison, a simple buy-and-hold strategy on SPY returned plus 316.3% over the same period, with a CAGR of plus 15.3%. Looking at the overall equity curve, we can see exactly how the strategy managed to perform relative to the broader market index. To truly understand these numbers, we need to break them down year by year. A strategy can look great on paper over a 10-year period, but if all the profits came from a single lucky year, it might not be a robust system for the future. When we look at the annual returns, we can see that Jesse Livermore's pivotal point system shines during periods of clear, sustained trends. In years when the S&P 500 experienced strong, steady upward movements, the strategy successfully locked into the trend early and rode it for massive gains. However, during choppy, sideways years, the strategy struggled, suffering from multiple small consecutive losses as it repeatedly tried to buy breakouts that ultimately failed. This is the classic trade-off of trend following, and the annual breakdown clearly illustrates this dynamic. One of the most critical aspects of any trading strategy is risk, and the best way to measure risk is through drawdown. Drawdown shows us the maximum peak-to-trough decline in our account balance, representing the psychological pain we would have to endure while trading this system. During our 10-year backtest, the maximum drawdown for Jesse Livermore's pivotal point system was minus 7.5%. When we compare this to the maximum drawdown of the buy-and-hold strategy, we see a very interesting story. Because Livermore's system incorporates strict trailing stops and can exit to cash during prolonged market declines, it managed to avoid the worst of the major market crashes. This capital preservation feature is often more valuable to professional traders than the absolute return, as it prevents catastrophic losses that are impossible to recover from. While these results are impressive, we must look at the limitations of this system objectively. Jesse Livermore designed this strategy for a market that was very different from the one we trade today. In the 1920s, there were fewer false breakouts because information traveled slowly, and trends tended to persist for much longer. Today, we have high-frequency trading algorithms, massive institutional liquidity, and instant news dissemination. This creates a highly noisy environment where whipsaws are incredibly common. A whipsaw occurs when the price breaks above a pivotal point, triggering our buy signal, only to immediately reverse and trigger our stop loss. If you trade this system in a highly volatile, range-bound market, you will experience a slow death by 1,000 cuts. It requires immense patience and discipline to survive these periods. So, what is the final verdict on Jesse Livermore's pivotal point system? Our backtest over the last decade proves that Jesse Livermore's core philosophy is still incredibly powerful. By focusing on critical pivotal points and managing risk with a trailing stop, the system provides a structured way to capture major market trends while protecting capital during severe downturns. However, it is not a holy grail. It requires you to accept a lower win rate and endure periods of frustrating sideways performance. If you want to succeed with a system like this, you must have the discipline of Livermore himself. Thank you for watching this deep dive on Backtested Hub. If you found this historical backtest valuable, please hit the like button, subscribe to the channel, and let us know in the comments which classic strategy you want us to backtest next. Until next time, trade smart and stay disciplined.